Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Take a look at the S&P 500 right now. At the sector level, your biggest gainer is those financials. That sector up about 2% as a whole. A lot of those gains, a lot of that strength is coming just from JP Morgan, which is currently up about 5.1% after taking the earnings stage this morning. Let's break it all down now with Bloomberg Intelligence Senior Global Banks Analyst Alison Williams joining us in the studio. Alison, it's already been a long day for you, but talk us through, of course, the reaction that we're seeing, because it seems like JP Morgan managed to surprise really across the board.
It did, and frankly, I think that the reaction is it's surprising to the upside in terms of how strong the stocks are reacting. I definitely think that we got good news from JP Morgan. I think, on the margin, good news from Wells Fargo. But in general, I think the stocks are also reacting to the potential soft landing for the banks. So we know that interest rates are coming down, and that the best case scenario for the banks are interest rates come down. It helps to spur loan growth. That helps net interest income. Credit continues to be solid. What we saw in the quarter, first of all, credit does continue to be solid. JP Morgan did take $1 billion reserve, but we think that's on the conservative side of things. Wells
Wait, you think they're being too conservative? They should have taken a bigger reserve?
I would say that the $1 billion is conservative. I think the fact is that their charge-offs, like the current day losses, came in lower than expected.
Right.
So that's a positive, right?
Yeah. So, basically you're saying the consumer is in pretty good shape and they were smart about their loans, right?
Correct. And in general, what the most of the provisioning we've seen is the fact that card loans are growing. So it's just about the growth. So, things are normalizing, as we say, which basically means they're going up to where they should be over time. But things are healthy. Net interest income, I think that's, the big news of the day. In fact, you saw JP Morgan stock bouncing around a little bit because they sort of went back to the beat and raise. We saw that for several quarters in a row. They beat net interest income. They raised guidance. We didn't really see that the last couple of quarters.
Did they set us up for this? I feel like we got set up.
I
feel like we've been duped, to be honest.
Yes.
I look back at the HCPI function, right? So I'm looking at JP Morgan stock 1 month and 1 day ago on September 10th. Daniel Pinto, the all-important JP Morgan president, came out and said, hey, you guys on the street, your estimate for net interest income is way too strong. We're not going to make that. And he pushed the stock down on that day 5.2%. Now they come out and beat on net interest income and raise their forecast for this year, and the stock is up 5.2%.
Yeah, and the two things he said, by the way, because he said net interest income is going to be lower, expenses are going to be higher. And so today we were looking for evidence, right, of, estimates have came down for net interest income. So have they come down enough? And so they came out, they beat the current number, they raised guidance for the fourth quarter, and then Jamie came out and said, next year it still looks a little bit too high. And so my guess would be, BI, we don't do estimates, but my guess is going to be estimates go up for fourth quarter and people wait to adjust their 25 to see what happens over the next few months. Because, as Jamie also said, things can change, right? And we are going to want to see what happens in terms of the loan growth and the deposits and all of that. But, to your point, they talked things down. They came out and did better. They also, similarly on the trading front, right? So trading and investment banking fees be pretty much across the board, except for the equity fees, maybe a little bit more optimistic. And we think that really sets up well for, Goldman and Morgan Stanley, which we're going to hear from next week.
Right. Well, let's talk a little bit more about Jamie Dimon, because, of course, you have the numbers, and then you have the call, and then you have, of course, what Jamie Dimon says. He sounded kind of doom and gloom a little bit, relatively speaking, on the economy. He also had some interesting things to say about cash, and I believe we have a clip of that.
I've been quite clear that I think things of the future could be quite turbulent. Cash is a very valuable asset. sometimes in a turbulent world. And you see my friend Warren Buffett, stockpiling cash right now. I mean, people should be a little more thoughtful about how we're trying to navigate in this world and grow for the long term for our company. I prefer to wait. We will be able to deploy it. Our shareholders will be very well served by us waiting.
I don't remember which one.
And so that was Jamie Dimon just talking about how he views cash as a valuable asset class still. And I mean, you're seeing that in money market funds. Matt and I talk about this all the time, the 6-point-something trillion
almost
in money market
6.5.
funds. Yeah. And it's interesting that, I don't know, I feel like for some of the regionals, that's painful. The fact that you have seen people maybe shift their deposits from banks into money market funds, but I guess that's not a JP Morgan problem.
So I think that, to the extent that obviously a bank has both deposit offerings and money markets, that's a positive. But I think in general, his point is where there are, a lot of potential risks, it's always good to have cash. Keep in mind that, one of the best things Jamie's done throughout his career, right, is be ready for the moment. So if you look back at the financial crisis, going into that, investors kept asking him, why aren't you returning capital? Why do you have so much capital? And that's where the term fortress balance sheet, I think, first came from. And because he had that balance sheet when a lot of other companies were weak, right, he was able to pick up the deposit franchise of Washington Mutual. He was able to pick up the prime brokerage business of Bear Stearns. He's only gone on to build those even stronger. Again, in the pandemic, picked up some assets. Even last fall was able to do some things. And this quarter, again, like that capital ratio, that was another, I think, really positive surprise for bank investors. They did a lot of buybacks. And that's why, again, I think sometimes a lot of his comments get headlines, but it's really the underlying philosophy that he's talking about in terms of there are a lot of structural risks out there. Lisa had a great interview recently where Jamie said, talked about the structural risk, but also thought the Fed did the right thing. So I think near term, things look very strong, but he's just pointing out there's a lot of structural things out there. He focuses a lot on the geopolitical risks, and cash is something very valuable to have when you see that sort of risk planning.
He's just heroic.
Jamie Dimon?
I mean, he's like otherworldly. He mentioned in that soundbite that you played Warren Buffett. And I feel like Jamie Dimon is probably Wall Street's, favorite sort of giant since Buffett.
He's
just always hitting home runs.
Yeah, but I don't know. I was listening to an interview that Charlie Munger did randomly a couple years ago, and he was talking about like the sleazy products that the banks sell. He didn't call out JP Morgan specifically, but I don't know. And Charlie Munger isn't Warren Buffett, but you think of them in the same breath. Yeah. This is a tangent. I do want to talk about Wells Fargo a little bit while we have you, Alison, because of course net interest income, that was the big headline for JP Morgan. It was also the big headline for Wells Fargo, maybe in the other direction, even though Wells Fargo, I think, is having a pretty good day. But
they're up more than 6%.
Yeah, but talk to us about that reaction, because they did miss on net interest income.
So they did miss, but I think once you they missed, and their guidance moved to down 9% for net interest income this year. Previously, it was down 8 to 9%. So I think initially when you saw those headline numbers, as I did, thought like, oh, this is negative. But digging into it a little bit, a lot of the downward guidance is really based on the miss that we saw in third quarter. And one of the things that they did was to restructure their investment securities portfolio. So really the fourth quarter estimate looks about stable. So the downward guidance really kind of reflected some of the pain in the quarter, if you will, and the investment banking business and a lot of the fees that they're seeing more than offset that. So they were able to absorb the loss, the hit from restructuring their portfolio, able to absorb the weaker than expected net interest income, and still deliver on the top line.
What's your favorite bank? I'm just putting together a comp chart. I'm looking at, which I always do, JP Morgan versus Wells Fargo, Bank of America, Morgan Stanley, Goldman Sachs, Citi. I feel like that pretty much covers it, right? Morgan Stanley over the last 5 years, killing everybody else.
So keep in mind, we don't recommend stocks and VI, but I
just meant your favorite bank to cover.
I can't talk fundamentally. I mean, for me, they each have their own great qualities. Obviously, JP Morgan, best in class, best returns, executing a virtuous cycle of technology spending that has helped the bank, 10, 20 years. So continued to execute really well. Goldman Sachs, best in class in that institutional business. And I really like the changes that they've made in the last couple of years. A lot of the diversification strategies, if you will, did not play to their core competitive strengths. I understand why they made those changes, but I think it's sort of a vote of confidence in the institutional business that they're kind of getting back to where they were. Morgan Stanley, to me, still has a little bit to prove, right? Gorman did an excellent job in terms of making acquisitions and shifting the business mix. But now Pick is going to have to deliver on a lot of the promises that Gorman made sort of on his way out the door.
I mean, the stock's pretty much tripled with
but they've changed. But the move from the institutional business to the fee side, right? So I think that was the better move than perhaps some of the diversification strategies that Goldman did. So Goldman backtracking, but Morgan Stanley gonna press their bet in terms of having that more recurring revenue, et cetera. So definitely done a good job there. Bank of America, U.S. Bellwether, and then Citigroup, just really a unique animal. I think disappointing for a long time in terms of trying to get operating leverage. That's a holy grail for them. And I think Jane Fraser finally making some good decisions. So.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
As a consolation, the producer said we could talk about cars all I want today.
Yes, beautiful.
And I think it's kind of helpful that one of the biggest movers on the day is Tesla.
Yes.
In terms of percentage losers, it is the biggest one on the S&P.
Big time.
Percentage gainers, the biggest one is?
Uber.
That's correct. And those stories are related. You may not understand exactly how at first, but we're going to bring in Kevin Tynan to talk about it. He's the director of research at Presidio Group, joining us from Princeton, New Jersey. How very Ivy League of you, Kevin. But not in your garage. I'm used to seeing you surrounded by like a wall of guitars and a V12.
There's
What's
nothing
going
on that wall.
Well, actually, I was just out there. We finished an engine swap in an older ML55 AMG truck. So I got a lot of scraped up forearms and knuckles and whatever, but it's running. So
I'm a fan of the ML55.
So the place is a mess. Basically, that's why I'm in here.
That's a Mercedes-Benz SUV that always reminded me of a hiking boot. It's like the same shape as a hiking boot.
I'm going to Google this after the segment.
Yep.
Let's talk about Tesla, though. They unveiled, Elon Musk yesterday, the richest man in the world, unveiled his cyber taxi or cyber cab, I guess. It's a driverless car. There's no steering wheel. There are no pedals. I thought the form factor was pretty cool. I mean, it's a fastback. Kind of looks like a Mustang Mach-E. But investors were super disappointed by a total lack of detail. Like, when are they going to come out? How much are they really going to cost? Are the regulators going to allow them to be sold in large numbers? What do you think about this cyber cab launch?
Yeah, I mean, and that's typically the standard operating procedure is somewhere down the road. It's basically to put ideas out there that this is not an automaker, right? Because that business is worth zero or less, depending, what you're building and how much of it. The interesting thing to me about cyber cab or whatever was, granted, there's no driver, but it was only 2 seats. Am I wrong on that? Or
that's so weird.
It would seem like
makes no sense to me.
It would seem like you would, right? Like you go out as couples, or you and a couple of buddies. Like it seemed like 2 seats, even though, I thought it should have held more people to that, but whatever. But no, that's ultimately the plan. Is that this is a company that is a story stock, obviously, and the narrative is every way that it is not an automaker, and it's about technology and all the non-disprovables down the road that get it the valuation similar to other, or even higher than other tech companies.
And he also revealed this robo-van concept that could transport as many as 20 people. I think we were showing images of the van, but I agree on the 2 seats thing. But Of course, you think about why this is going over so poorly in the stock market. It's because the timelines here are so squishy. I mean, you think back to 2019, and Elon Musk said that he was going to have 1 million robotaxis on the road the following year, and that obviously did not happen. We are in 2024. But, I mean, Kevin, you point out in your notes that this is sort of, par for the course for Tesla and for Elon Musk specifically.
Yeah, I mean, look, there's every excuse of he doesn't make it, but he eventually gets there or whatever. And I think the issue with the stock today versus competitors is that one, it proved that he isn't far and away ahead of anybody, if at all, or how far behind, because those competitors have come out very recently and said like, hey, besides the science and the regulatory environment, this still has to make money someday. And we're very far away from that. And I think when you look at the event last night, he didn't answer any of those questions. If those are the three big things, like, hey, is it possible? By when? And when does it make money? The investors really didn't get any of those answers. So you sell off one and you buy the others that at least, if nothing else, might not be any closer, but they're being more realistic about the goals.
By the way, there already are driverless like robo-taxis in San Francisco and probably other super progressive cities. Why is this such a big deal? Why is it so hard to achieve it? Waymo already does it.
Yeah, well, I thought what was interesting going back a way, they talked about, because you'll hear it all the time, especially from the bulls, about how much data they get from full self-driving already being on the road. But the question is, how much of it is actually usable? How much is actually teaching anything, right? If nothing's happening, what are you learning from that data? So you can collect all the miles, but until you have a disengagement or an event, it doesn't really learn anything. So, I think it's a little bit of that, is that people get distracted by how much data they collect. But my question is like, how much of it is really usable? And how do you prepare or plan for all the things that don't happen all the time, or are very rare? So, I don't know that, the question of the science of it to me is, and the safety of it is paramount. And that's before you get into all the other issues, right? The regulatory issues and the profitability issues. So, I think investors are looking at it like the Ubers and Lyfts of the world, or even Waymos of the world, that are being a little bit more conservative on timelines, on safety, on profitability, are being rewarded, I guess, for lack of a better word, in this market.
Yeah, Uber in particular screaming higher on this Friday afternoon. But Kevin, you made the point that when it comes to Tesla, it's a story stock. And the story for Tesla has become a little bit murky. When you think about Tesla, I mean, what story do you think that investors would want to latch onto here?
Yeah, I think it's that it deserves, because it has even beyond technology multiples. So this can't be an automaker, because then you would be getting 4, 5, 6 times, and it's getting 10 times that. So this can't be an automaker. So all the issues with supply versus demand, overcapacity, price weakness, margins compressing, all that is discounted and pushed aside. And then you look at it and you say, okay, but what's coming? And this is an I don't know, hundreds of billions, $1 trillion market, and they're ahead, and that's the narrative. So, to an extent, it almost feels like the product of this company, because a lot of things that they show and talk about don't actually exist, or aren't marketable, or aren't revenue generating. The product is the stock at this point, when you're in between these cycles of growth in the auto industry or in the auto division, which isn't really happening. And you don't have these other products that you've promised on your timeline yet.
It's still worth a shocking amount. Even though it's down by half since its high in 2021, it's a $700 billion stock. I mean, the Ford Motor Company, is a $40 billion stock. General Motors, which has been doing better than any of the other car makers this year, it's only a $54 billion stock. So, I mean, it's pretty insane that Tesla's worth 14x General Motors.
Well, look at even a Toyota of the world, right? If they're a better manufacturer or automaker than that company top to bottom, and the valuation dwarfs it, which just tells you that the market isn't thinking of this company as an automaker, because if they were, they would be an also ran or even a not very good company.
Toyota's worth $275 billion, so not even half and barely a third. Let me ask about Uber. When I got here in the morning, I didn't quite grasp until I started reading through notes, why Tesla's failure is Uber's success in this space. What do you think?
I think it's just it's the removal of uncertainty, right? There was all this build up to the Tesla event, and then there's the belief and probably isn't a zero-sum game, but at least that's the way it's played out today, is that, oh, okay, Tesla doesn't have it figured out yet, and we don't know when they will, so everybody is sort of still in play. So, when you look at the valuations, Tesla's priced for perfection in all of these ancillary businesses, and last night kind of proved that they're not really worthy of that yet, at least not at this moment. And then it provided it removed some uncertainty about the things that Uber and Lyft had said recently.
I mean, we have a big take story, which we're going to talk about in just a few minutes, about how Uber is saving hundreds of millions of dollars by essentially screwing drivers, right? Stopping them out of its technology stack so that they can't get customers or can't work. I guess the idea is, if Tesla were successful, it would take the driver out of the equation. You wouldn't need an Uber, but then somebody would have to operate the Robotaxi fleet, right?
Yeah, you would still need fleet management, and and again, how far away is that? I know, in my own mind, like, how ready am I to walk out of an airport terminal and get in something without pedals and a steering wheel to go 45 minutes into the city? That's after that I'm convinced that it's safe, that the regulatory environment is favorable, that the companies can stay in business because the technology is profitable. So again, I think that timeline is way longer than is priced in for some of the stocks right now, because I don't think it's around the corner.
All right, Kevin, really great to speak with you. Of course, all things cars and what's going on in the world of cars. That is Kevin Tynan. He is Director of Research over at the Presidio Group, joining us from Princeton, New Jersey.
I miss you, bro.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We have a real treat now. We're going to speak to Brett Keller. He is the CEO over at Priceline. Matt, we already spoke to Brett today at 10:30 a.m., and it was so good. We said, please let us anchor radio. We want to talk to Brett again. So we're going to do that right now. Brett, great to speak with you again. We really appreciate you being so generous with your time. Talk to us about the launch of Penny Voice, of course. Penny, it's this AI chatbot, is my understanding, that launched in June 2023. It helps you book travel. Penny Voice is the next evolution of Penny. Explain to our listeners exactly what Penny Voice is designed to do.
Sure. Well, Penny is integrated across all of our user experiences, and a consumer can come in, and as they're either planning a trip, booking a trip, or looking to service their trip, they can engage with and activate our Gen AI chatbot. And over the last year, our consumers have been chatting back and forth with her to address a number of different needs. Just within the last week, we announced a new partnership with OpenAI. We're one of the first brands in the world to connect to their new real-time voice API, which enables conversations in real time, as opposed to talking to a bot, which then translates into text and back and forth, which really slows down the experience. This enables a consumer to have a real conversation. You can interrupt Penny mid-flow. You can ask her more challenging questions, and she's able to help you do a number of things. So trip planning, for example, you need ideas about a trip you want to take to a location you've never been. You're going to Japan. You want to learn some of the things that you want to do in a specific city, or even what cities to visit. She can help you with that. When it comes to booking a hotel, she can answer questions about the specific type of hotel you're looking at or one that you're interested in. And once you've booked your trip, she can even help you service it. For example, if you want to cancel it or make a reservation change, she can walk you through that flow. And if she can't help you, she can quickly hand you off to a live agent who can deal with the more complex scenarios.
So one of the issues with AI is data gathering. Where do you get your data? Is it all just from the Priceline website, all from the resorts and car rental and airline companies with which you work?
Yeah, so it comes from two areas primarily. The first is our inherent data pool that we have here at Priceline. That's all of the information that we have about all of the products and services that we sell. That's, for example, descriptions about the hotels, all of their amenities, their price points, their availability, et cetera. But Penny also has access to outside information. So the same type of information you might find on OpenAI, we're just able to stitch that all together to make it much more relevant to the trip that you're planning and considering. And so we tie those things together to give you the best view from a traveler's perspective.
So she could say, like, this hotel is better than that. Or I guess, Katie wants to go to a hotel for dressage.
Yes.
I don't know if they have those hotels, but
in
she can tell you
Wellington.
the best dressage hotel.
That would be really fantastic. So I am curious, how comfortable is your user base with AI, with using an AI tool? Because Penny, the original Penny, has been around since June 2023. I asked you this at 10:30, and I'll ask you again. What has the uptake looked like so far?
Sure. Well, like any new technology, you have your early users and early adopters, and that's what we're seeing now, right? Those who either really aren't comfortable with everything that we offer in an online environment, that might be one set of consumers, and those who are just early adopters and really want to engage with the technology, I'd say that's another set of consumers. But consumers are asking a broad range of questions, everything from, can I bring my dog with me to this hotel? What's the fee associated with that, right? If I cancel tomorrow, can I do that? And so they're asking lots of different questions about their stay, and they're planning trips with this. And so we're getting a pretty good adoption, I would say, and as I mentioned earlier this morning, the adoption rate has literally been doubling each month that we've had this product on the shelf. And right out of the gate, within the first week, more than 5% of our engagements with Penny are actually now taking place by voice. So that's being adopted relatively quickly as well, since that just really came out.
Do you have any numbers? Because 1 to 2 is doubling, but that's still not a lot of customers. How many people are using it?
She's had millions of conversations to date.
Wow, that's more than I've had.
Yeah. What kind of advantage do you think this gives you over your competitors? Surely they're going to try and catch up or do something similar. Can you take market share right now, being, first to market?
To be honest, that's probably early to make that kind of a statement in the marketplace. But like all of the technologies that we've seen over the past 3 decades, right, since we've been in the online travel game, those who are first to market with new technologies that really matter will have an edge because they adopt it faster into their booking flows and into their trip planning services. And that gives you a leg up for a few years because there are many of our competitors who are just much bigger, slower, more legacy companies. It just takes them time to adopt this and really apply it in the space. And online travel agencies, in particular, Priceline, is faster to move with this. We saw the same thing when the iPhone first came out. We were one of the first to market with a travel app. Now everybody's got an app. Everybody's UXs have generally caught up. But in the early days, we had a couple of years worth of a lead that lasted for some time because of our speed in innovating with these products and services. And no one's doing it the same way, right? We look at what we're doing, and it's different from what some of the other leaders in the travel category are doing. So we're really excited about where we're going. And we think one of the bigger opportunities, of course, is to also have Penny answer the phone when you call our customer service center so that you're talking with an agent who really can service you at an extreme pace and with extreme accuracy.
Hopefully we can get a human, though, if Penny's not dealing.
Always.
Yeah,
we will
I
always
like to
give you access to you.
I like to talk to humans like you, Brett. Thank you so much for joining us.
Thank
Really
you,
a
you
pleasure
bet.
to have you on Bloomberg Radio and Television with us today. Brett Keller, their Chief Executive Officer over at Priceline out of Norwalk, Connecticut.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Great conversation coming up now. Let's welcome in Dr. Kelly Monahan. She is a managing director over at the Upwork Research Institute. Upwork, of course, it's a work marketplace. It connects independent highly skilled freelance professionals from around the globe to one another. And it's interesting. You take a look at the recent work that the Upwork Research Institute has done, and they're out with a key workplace practices of highly performing companies report. And Dr. Kelly Monahan, let's start there. Talk us through some of the key practices that you've observed at such workplaces.
Yeah, thanks so much, Katie. But let's start before we even talk about the practices, how few leaders are actually doing them today. Our research found that only 27% of global leaders are actually engaging in what we're calling these high-performing work innovator practices. And so they're hard to come by. But those three practices are those companies that are embracing distributed work. We still know there's so much conversation headlines around RTO and where people should be working. But the reality is our leaders have moved beyond that and really focusing on the how of people, how they work, and moving on to hybrid work. The second thing is they're embracing generative AI, but not in a way that's siloed or chasing a shiny object. They're incorporating it into their tech stack and making sure they're thinking about the workforce experience as part of that. And then finally, in today's labor markets, you have to think about talent differently. And so these work innovator practices are those that are actually looking beyond their corporate walls, beyond the full-time employment model, and looking for freelancers and managed services as examples to find talent.
So what are the actual practices? Like, I feel a nap room is important.
A wellness room.
Yeah, a lot of places don't have that. Showers would be great. A pool table.
Agree with
like,
that.
What are we talking about here?
Yeah, so those are all great perks. I would say those are perks as opposed to practices. But what our research is finding, I don't know if you guys feel the same way, but the majority of this comes to how we relate to one another in the workplace and leadership and culture. So you can have a nap room, but if you don't have leaders who actually see you when you show up to work, actually engage you in a way that's helping you become more productive and help protect your well-being, what we're seeing in the research, those are all external, and those tend to have a short-term carrot to them, attached to them. But when you come and work with leaders who are engaging you, allowing you to work with the newest technology, trust that you want to work and be there, those are the type of practices that we're seeing help companies get ahead today.
I think wellness rooms are important as long as you use them responsibly. You know, maybe there's a reservation system, for example.
Wait, your boss is supposed to talk directly to you?
What's that about?
Exactly. And just not that, I don't know how to, but like what we're finding is so many people are feeling far behind when it comes to a skilling perspective. And what our data and research shows that what people are actually looking for today is they want to stay future employed. They want to make sure that their employment's protected. And the best way to do that is through skilling initiatives. And so we do see a lot of that come through in our data as well.
Can we talk about return to office and physical presence in the office? And I'm curious what you observe among these high-performing companies. I was at the Knight Badgett Fellowship dinner last night. Ken Griffin was speaking, which was pretty interesting. And he was talking about the importance of having everyone in the office. Of course, Citadel made a point of that during the pandemic, bringing people back pretty early. What are you seeing when it comes, again, to the physical presence of such companies?
Yeah, absolutely. It's a great question because it is something that we're still obviously trying to figure out across the board, across industries. Here's what I can tell you what the data says. So we went out and surveyed over 1,500 global leaders. And what we found is that 100% of the companies that are winning and protecting their balance sheet today, and they're protecting it by lowering the operating cost by 30%, they're having year-over-year cash flow of over 18% higher than their peers, and they're lowering their debt to equity ratio. They are enabling some level of flexible work. Doesn't mean they're remote first, doesn't mean in-person time still matters, but they're getting that times right. And instead of just saying arbitrarily, you have to come to the office 2 to 3 times a week, instead they're saying, what are the moments that matter where we need to bring people together? Oftentimes that's for training and development. That often means for bringing community together and really reconnecting in relationships. Oftentimes the work is best done individually and in a remote environment, but the in-person time matters, and those high-performing companies are bringing people together at those critical moments.
The other good thing that Citadel does for its employees, well, at least if you're an intern there, you get $20,000 a month.
I like that.
Which I think is a pretty good work environment. How much does that matter, actually, Doctor?
What do you mean? In what way? Just in terms
just
of
paying
giving
somebody a ton of money.
Yeah.
Does that have a huge effect on that person's motivation?
Hey, you know what? That's a great question. I just wanted to dispel a myth because I think that is oftentimes we think, okay, pay people more and they're going to work harder. Absolutely, you have to pay people a fair and justable salary and wage. I mean, that is like table stakes in today's environment. But what's more important are those intrinsic motivations. Again, that's, do you have a sense of autonomy in the way you're working? Do you feel connected to your coworkers and your colleagues? Do you feel respected? Do you have dignity in your job? Those intrinsic motivations tend to lead people to do much more productive workforces. Yes, money is important. Let's make sure we get that right. But the reality is, again, that's going to be short term in terms of the way it's feeling your motivation.
Yeah. I don't know. I really like money. So
No, to some extent we're kidding. Obviously we do like money.
Yeah, for
but
sure.
I always think it's interesting to look into the science of how happy money actually makes you. If you're an intern, of course, working there for 3 months during the summer, it's going to be sweet to get 60 grand.
You have an end in sight too.
Yes,
you know?
exactly. But for a regular person, I don't know, is a Citadel employee necessarily happier than an employee of Boeing?
I mean, maybe if they work in Miami,
How about that? Does the city matter? I mean, I feel like I'd be much happier with a company that was headquartered in Miami than one that was headquartered in New York.
Chicago.
Yeah. Where
they used to be.
Well, listen, I'm in Orlando and we just came through a hurricane. So I do think place matters a lot, in today's environment. And what matters to me the most just going through this situation is, again, managers and colleagues who are checking on me, providing that support. When it comes to place, it's really much more who's your community within that place as opposed to the city itself. And I think, again, we're on the forefront of this. And I think we're going to continue to see internal mobility and where people choose to work, again, depending on where their company and how open and flexible they are. But the reality is, it's so much less about where we work today and so much more about how and what our research continues to point to.
All right, Doctor, really appreciate your time. Really appreciate you rolling with us, too, on this Friday afternoon. That is Dr. Kelly Monahan, of course, Managing Director over at the Upwork Research Institute, joining us from Orlando, Florida. Glad, of course, that you are safe and well.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, without question, the greatest SOT string that has ever been compiled. This is the Drive to the Close. I'm Matt Miller here in the Interactive Brokers studio with Katie Greifeld. We are filling in for Tim and Carol, who are on the DOS, as the British would say. They're on a travel day back from Los Angeles.
And God bless them.
Yeah, God bless them for those perks that they're able to wrangle somehow. We want to talk about the 45th record high on the S&P. Okay, we're not sure it's going to close at this level.
There are 18 minutes for things to go wrong.
Exactly. But, 58.18, we're already above almost every strategist target on the street. We're starting to see strategists raise them up. But last time I checked, out of 22 that we survey, only 3 think that we're going to go higher by year end. I'm sure the rest do also, but they just haven't put in their new numbers yet. Let's talk to David Dietze about this. He's Managing Principal, Senior Investment Strategist over at Peapack Private Wealth Management. Joins us here in the studio. David, great to have you here in person. What do you think about this record after record after record? I mean, I thought the Fed's rates were restrictive, but certainly not in terms of the stock market.
Yeah, absolutely. So we're in a bit of a Goldilocks situation here. I mean, earnings is always the most important thing as far as I'm concerned for the market. And of course, with the banks reporting today, that's the unofficial kickoff of the third quarter earnings season. And they basically blew it out of the park, beating expectations very handily. And, the banks are important, not just because what their numbers are, but as barometers really of the economy, because they're dealing with companies in all sorts of sectors all day long. And so I think that developed a great positive sentiment. Of course, the second most important thing really is interest rates. Every day, people are saying, should I buy a bond? Should I buy a stock? And as these interest rates have started to recede from their highs about a year ago, and as the forecast from the Federal Reserve is for lower interest rates, people are shifting money, I believe, from fixed income into stocks. And of course, in the real economy, that makes CapEx expenditures a little bit more affordable if the price of money to build the factories or whatever it is less. And of course, consumers too, going out to buy a car, going to look at a mortgage. Mortgage rates are a good 1% less than they were not too long ago.
Rates on cars are still a little bit too high.
Yeah, Matt actually knows a lot about that.
If only someone would make the interest on car loans tax deductible.
And, we talked about that with the other David, though. We have to talk to this David, and we're going to talk about your ranking system, because I think it's interesting that you said it's earnings and then it's interest rates, because we talk to a lot of people who take the other side. When you say that earnings are most important, are you talking at the index level, or are you talking at the single stock level?
Oh, really both. I mean, at the end of the day, you buy a company for not only their earnings today, but for the growth of earnings. Interest rates will fluctuate up and down, but if ultimately a company is not going to increase sales, not going to increase earnings, it's not going to go anywhere. So I do think that's most important. Obviously, you like to have both the index earnings going up as well as your particular company's earnings going up. But if you can't have the index, at least you can hire a stock picker.
Were you encouraged by JP Morgan this morning and the slew of, Wells Fargo? Who else reported this morning? The kickoff, BlackRock, exactly, $11.5 trillion in assets under management. Were you encouraged by these earnings? Because they do undergird the entire economy of the United States of America.
That's the second
right?
time I've heard you say undergird today.
I actually thought of that word this morning, and I'm going to keep saying it now. I don't even know if it's a real word.
No, it is.
So it was encouraging, I think, for a number of reasons. I think a lot of people were looking at their portfolios, particularly their commercial loans. Were they going to see some massive write-offs or something like that, which should suggest that a lot of borrowers are having trouble paying? We didn't see any of that. There's a little bit of weakness in the credit card portfolio, but I think most strategists are saying, yes, at the very lowest areas of the consumer spending levels, those people unfortunately are having problems, but the heavy hitters are paying their bills and spending more. Certainly the net interest margins, that all important gap between what they're paying on their depositors and what they're getting for their loans, continues to look much better than expectations. So I thought it looked pretty good.
Look pretty good. Well, we have a lot more bank earnings coming up, and then we get the regional banks, which should be really interesting. They've been interesting, maybe more interesting than the big banks, of course, since the collapse.
Maybe more important to the economy, right?
Exactly.
Because if you care, David, about the whole economy, do you really care about Goldman Sachs trading revenue?
Well, they are major. It's in the Dow. It's a major bank. Certainly, there is a difference in their businesses, because you got those major banks have a lot of trading revenue. They're exposed to that M&A market, that IPO market. Those are things that are not really part of the business of the regional banks. So I agree with you that the regional banks, you get a better sense as to the how things are going on Main Street in the middle market areas.
You mentioned the Dow, and unfortunately, I don't care about the Dow, which Matt knows very well.
I still care, though.
Yeah, no, and a lot of people do. I care about the small caps. We talk about it because usually we can show three indexes. So it's like, do we go with the Dow? Do we go with the small caps? You should have had the Russell 2000 up for the past 3 months, I would argue, because they've been a very interesting cohort of this overall equity market.
Yeah, absolutely. So we've actually been a fan, perhaps a little earlier than we should have been, of the small caps. And the reason, quite simply, is their valuations are much cheaper relative to large cap, of course, versus the Mag 7. And they're also cheaper than they have been trading at typically. Actually, they usually trade at a premium to the large caps because they have more growth potential. We have not seen that, so we keep thinking that there will be a reversion to the mean. I think the main headwind for them has been those high borrowing rates and the potential threat of recession. Because they're smaller, they have less of a cushion, so they're going to be more susceptible to the vagaries of the economy, and they're more likely to have to go to their local bank, who, by the way, was very sensitive as to how much more credit they wanted to extend. But now, with interest rates coming down, with the valuations being really at nosebleed levels for many of the Mag 7, I think investors are looking to broaden out their portfolios and take advantage of that. And of course, today you will notice that the Russell 2000 is beating the pants off a very fine performance of the other indexes.
There you go.
Does the election matter to you? I mean, not personally, but as a strategist.
Well, so yes and no. It really depends on your time frame. Now, we urge our investors to take a long-term time frame because that gives you the best chance of having success making money. And I always go back to what Warren Buffett used to say, I've been investing through 16 administrations, 8 Republican, 8 Democrat. I've done just as well, no matter who was in charge and in the White House. So we don't think longer term. really affects what's going on. In the short term, though, I do think there's some hesitancy. We heard from Delta yesterday where people are not even wanting to book travel around the election itself because people, I don't know, perhaps are afraid of disruption in terms of the investment, in terms of the election results. So we think that after we get past the election, you could actually have another tailwind to the market.
David, it is great to see you. Really appreciate you coming by on this Friday afternoon. That is David Dietze. He is Managing Principal and Senior Investment Strategist over at Peapack Private Wealth Management.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.